Good evening, everyone. Time for another silver update. You are looking at the 4-hour chart of silver with a couple of trend lines I've drawn. One is a long-term trend line. The other is a relatively short-term trend line. As you can see, we have penetrated the short-term trend line, and we are close to penetrating the long-term trend line. The resolution for this flag formation seems to be going to the downside, so we may be in for a bout of selling. So I'm going to do a couple things that I usually don't do. First of all, I'm going to give a short-term semi-bearish forecast for the price of silver, and the next thing I'm going to do is give to you one of the paper plays that I've initiated in regards to this. But before I do that, I wanted to, let's first pull out a little bit so we can see the other trend line that I drew. And I have to actually, I think it's on the daily. So this is the other trend line that has not been penetrated yet. If this is penetrated, we may see significant downside action. But we have penetrated the nearby one. So we're going to have to wait and see if we resolve to the downside. Now I wanted to take you over, first of all, to the article that gave me some pause as to the short-term direction in the silver market, and that was this most recent article that one of my listeners pointed out by Clive Mond, and he put this out September 11th, 2011, and he says, "The picture for silver looks increasingly ominous, and it is suspected that we are close to a major breakdown that will lead to a violent plunge of a similar nature to that which occurred in early May. The picture has darkened over the past week with increasingly bearish action by gold and a major dollar breakout that was predicted on the site a few days before it occurred in the article The Great Dollar Shocker. The year-to-date chart for silver shows the rally from May-June lows to be insipid and weak, especially given the sparkling performance by gold over the past several months. But perhaps this is not so surprising given the shock and awe treatment meted out to silver speculators early in May, some of whom understandably appear to have adopted a once-bitten, twice-shy approach to silver ever since. However, there's an old saying that hope springs eternal in the human breast, and knowing this, silver's cheerleaders have been shepherding their surviving flocks back into silver in recent months, but sadly our latest chart suggests that they are likely in for another fleecing, and they may not survive the next one." He then gives his chart, and he says here, "This time it's different. It had better be, because if it isn't, silver could be on the verge of a devastating sea-wave decline, which will wipe out a lot of traders. The rally following the May smash looks insipid and weak and is suspected that it is B-wave counter-trend move of a big ABC decline." So from that, and he points out some interesting technical indications. He's seeing a rollover top here, and he's seeing a potential breakdown through this trend line, which is similar to the trend line that I drew. He also shows a MACD, which is getting weaker while the price is getting stronger. He's expecting that to roll over to the downside. He's actually putting a target of 28 with support at 34. That would be really surprising to see those prices. I'm never going to say never, but I would really be shocked. He goes on to say, "While we have had some trouble with the wave count over the past several months, most Elliott wavers get lost in a labyrinth of excessive mentation, which is why, as practical speculators, we don't bother with wave theory much and instead focus on more usable indicators like support, resistance, and levels of volume." Now that's kind of interesting that a Elliott wave person is going to say we don't bother much with wave theory, focus on indicators like support, resistance, levels, and volume. So what good is Elliott wave theory? For the most part, I think Elliott wave theory is a lot of hocus pocus. I mean, the idea is that things go up in 5 waves and down in 3, and maybe there's some truth to that, but I've never seen, and this guy, If you look back on his history, he was associated with Robert Prechter and the Elliott wave theory. So I'm going to link this. You can go ahead and read it. He's calling for a top, and of course this is paper silver. You have to remember he's talking about paper traders and paper silver. Now, just so you don't dismiss him so quickly, I did pull up an article that he wrote, and this is what he said back in late April, April 28th. He said, "The big question on the minds of silver investors and especially silver traders is whether the melt-up in silver has run its course or whether it has further to go. On Monday last week, we saw a temporary burnout with a reversal day showing up on the chart at a point where silver was fantastically overbought. On the basis of this and also the extremely bullish public opinion on silver and extremely bearish public opinion on the dollar, the public are normally wrong, it was reasonable to conclude that silver had either topped out or a correction was imminent." And he goes on. I'll link that too. But you can see he gives a similar chart. This is April 28th, and this is right when silver was near touching 50. And he gives a lot of technical reasons why he thinks silver is due for a violent sell-off. And as you know, on May 1st, silver had a violent sell-off. Now, it's interesting that that violent sell-off coincided with the big bin Laden capture announcement and with a series of surprise overnight margin hikes in the price of silver. So, was it manipulated? Yes. Was it planned? Yes. But nevertheless, you've got to give him credit that he was right. So, following his advice and looking at the technical picture this morning, I decided to do a Street Money 21 type of deal and put some paper hedges on just in case these people were right. So I want to show you what I did. I'm not recommending that anybody follow me. I'm just giving you an idea of what I did. If you go to Yahoo, you have a number of paper ETFs and ultra ETFs that you can trade. The one that I traded was the AGQ. This is an ultra silver long. As you can see, the AGQ has run from about 20 or so all the way up to 350, but recently, since a year ago or so, it ran from about 60 or so all the way up to 350. So there's a lot of pop in this. Now, you have to be very careful when you trade ETFs because ETFs have a time decay built into them. The bias on all ETFs is to the downside, and I'll show you. The other ETF that's ultra silver, the key one, is the ZSL, and I think these are both triple times leverage. So you can see this is the ZSL, and let me pull up the 5-day on it. We got a pop today. You pull up the max though, and you can see that's 1,000, equivalent of 1,000, 2009, all the way down to where we are today, which is 12. So that's losing 99.9% of its value. Now, if you want to chart these and compare them, you can just compare them side by side. And this holds true for every one of these ultra short, ultra long funds. They mirror each other, and actually I've done a video on this before, but I'm going to go ahead and do the same point so you can see it again, especially for those of you that are new and haven't seen it. So we're going to do a ZSL overlay comparison with AGQ, and you'll see that these are mirror images of each other, as they should be, because one is ultra long and one is ultra short. So you can see they almost look like some kind of unique artwork drawing or something like that. Now, if you go further out, you can see, well, let's stay here. You can see we've got about 9% up and about 9% down. Let's start moving closer in, though. Okay, so the AGQ is up about 3%. Now, the ZSL is down about 9%. Let's keep moving out. Now, we're down 30 and up 20. Now we're up 20 and down almost 60. Now we're up about 40 and down about 60. We're up 200 and we're down nearly 80. And that's 2 something and off the charts. And looks like 800, and then we go to the max. So this one actually doesn't look like all the others. You have to take my word for it, but normally when you look at these, both of them are down. In this case, the AGQ is actually up, which is very unusual, very rare. So I wanted to get that warning off the top. If you're going to play these, you always have to play them from the short side. So obviously I'm not going to buy the ZSL, even though that's the ultra long, because it has that built-in decay bias against it. So I have decay working against me. So if I'm going to be bearish on silver and I want to play, I'm going to want to play with the AGQ. So what I'm looking for is to short the AGQ. Now, obviously, I'm not brave enough to short silver or even short a triple silver. So what I did was I went into the options, and the one I chose was just next month, and I went and picked the 190 put, which this is the one I purchased here. So I purchased the 190 put early on before silver broke down through 40, so you can see it's up $1 today. But if silver gets a significant breakdown or even a significant bounce, obviously the price of AGQ is going to react very violently because it is a 3 times leverage. So a $5 drop in silver is going to really affect the price of this. So that's the hedge that I put on, and the reason I did is because I'm seeking to take some paper profits out of this market, which we know when they do take silver, if Clive is right and Street Money 21 are right that we're going to have a downdraft here, then it's in my interest to try to take some paper profits out and turn them back into more physical silver, and that's my plan. So we'll see how the plan works out. Now, I wanted to take you over to the main topic here, and that's going to be the FOFOA article that has recently come out. And this article is about, it's actually an excellent article. I'm not an FOFOA hater. I completely disagree with FOFOA about silver. I think that silver has a role and gold isn't the only thing out there for people to invest in, but that's a disagreement. But this is an excellent article that gives the history, a very interesting history of the London gold pool and how it operated. And you can see very clearly when the history of the London gold pool is given. There's a lot of other history in here as well. But and here's a speech by Charles de Gaulle where he talks about how they need gold and not dollars. It's very interesting, but the London gold pool especially is, and here's the section that describes how the London gold pool operated, was nothing but an organization of Western states in an agreement to suppress the price of gold to support the dollar. So it's very clear that's what they did. I think it's very clear that's what they're doing. But the main reason I brought this up is I wanted to look at a little section here where he makes some very interesting comments about gold. And I wanted to apply these to silver. He's talking about what the true value of gold is if gold went back to fulfilling its role as free gold. He makes a very good case of that, where gold needs to be the actual commodity that balances trade between nations. And so he's discussing the return of free gold, or the return of gold as a true balance of trade currency, and all of the benefits that would be from that. I completely agree with that. I just would add that I would like to see silver also be traded as well, bimetallic. But anyway, this point about gold is very important as far as the LBMA's paper leverage. Let's read this real quick here. And that's because the price of gold today still does not reflect the physical flow of gold that would normally be a function of arbitrage, with speculators transporting gold to where its purchasing power is highest. The flow of gold today is still sterilized by the paper gold trade within the LBMA bullion banking system that, by a recent LBMA survey, was around 250 times larger than the flow of new gold from the mines. That's a total turnover in the LBMA sale plus purchase of 5,400 tons every single day. That's the equivalent of every ounce of gold that has ever been mined in all history changing hands in just the first 3 months of 2011. That's what the LBMA members themselves voluntarily reported, and that's a lot of paper gold that is still sterilizing the economically beneficial price mechanism of that physical gold would otherwise be transmitting. So that's the important paragraph here. Now, FOFOA is pointing out that it's through the LBMA's paper leverage system using counterfeit gold that sterilizes the function of real gold. And you'll have to read the article to understand what he's referring to when he's talking about the function of real gold and how it really works to balance trade. And I could not agree more. It's a far better system than any type of fiat pegged or Bretton Woods or all these other crazy systems that governments have come up with. The free gold system is by far the best. But the interesting point I wanted to point out here is that he starts to talk about the LBMA and their counterfeit gold. Now, an interesting thing here is that he gives us a link to this recent LBMA survey. And when you click on it, it takes you to this PDF that's put out by the LBMA. And it's bank-only gold and silver to support market maker requirements. This is where he gets his data from. Now, this one is the Local London Liquidity Survey, but then it says LBMA Gold Turnover Survey for Q1 2011. Now, this is where he draws his figures from as far as the tonnage, turnover, etc. But what I found interesting about this is there isn't a silver listed in here. This is just the gold, even though at the top it says silver and gold and silver. So the first thing I would like to look for is a LBMA silver turnover survey for Q1 2011. And lo and behold, when you search for that, and I've done some extensive searching here, you find that it doesn't exist. There was no LBMA silver turnover survey. So through a lot of subsequent searching that I did manage to find a document that comes from the LBMA, and this is a document that gives you a turnover and ounces transferred. Now, this is in ounces, so you have to convert, and this also ends at 2008, which is kind of interesting. Now, any of those of you out there that can find these comparable figures for silver as opposed to gold, I'd be really interested in seeing those numbers. But what jumps out at you really quick here when you see this is that pretty much there's a 10-to-1 ratio. You can see for every 30 million ounces of gold that turn over roughly 300 million ounces of silver. When you're down below 20 million, you're down below 200 million. It's not perfect, but it's a rough equivalent. So you're roughly looking at a 10-fold factor. So if we go back here, the one that FOFOA cited, we can guess that of the silver, if it's 5,400 tons of gold, it's probably 50,000 tons of silver. So we know that there's roughly, I believe it is 32,000 ounces per ton. So yeah, it's roughly 30. I don't want to get messed up in the troy ounce and all that conversion. It's roughly 30. So we'll just go with 30,000. So we know that we're doing with silver, if his figures are correct, that we're doing roughly 50,000. So I'm going to bring out my dreaded calculator here. And I've got my commas in here, so it's going to be a lot easier. We've got 50,000 tons. And we've got 32,000 ounces per ton. So that gives us 1.6 billion ounces of silver. Now that's almost 2 years. 2 years worth of silver. So if FOFOA is shocked that the LBMA could turn over the mining output of every ounce of gold in history in 3 months, would he be even more shocked that the LBMA turns over twice the yearly amount of silver mined in a single day in 2 years? So that's a shocker. I challenge you to go and do the math for yourself. If what FOFOA is saying about gold is true, then it's tenfold true for silver. And just to show you the charts, because he has an excellent chart here about his percentage projection for the price of gold, and you can see that the median projection is $55,000 an ounce. There's a 2% chance we get to 100,000. There's a 2% chance we were between 10 and 25,000. So I would take 1/10 of that, and I think that would be conservative. And that's a $5,000 an ounce silver price. So very interesting information. I challenge you to do the research and the math yourself. So just to summarize, we are falling now in a fairly bearish pattern. I've taken the advice of Clive Mond and Street Money 21, and I have hedged my silver position with paper shorts, specifically buying the AGQ 190 put. And I'm going to follow up and let you know how I do. And of course, if I do real well, I'll turn around and buy more physical silver. And we'll talk to you next time.